Venture capital, or VC, is a type of private equity investing that typically targets startup or small companies, where there is an opportunity to deliver high growth and consequently high returns for investors. What VC funds can offer is to provide capital investments, raised from its own investors, often referred to as LPs or limited partners, and create pooled investment funds for the purpose of investing equity capital into these private small businesses. These can include innovative and promising tech startups or new and innovative technologies with high growth potential. These are companies that would likely not receive financing from traditional bank loans or credit facilities. As an asset class, venture capital is unique. VC funds make equity investments in companies whose stock is essentially illiquid and worthless, hard to value, until the company grows and matures over time. As an asset class, venture capital can offer interesting investment opportunities into new companies or new emerging sectors or subsectors. Businesses are usually in early stage, so may not yet be profitable, and therefore will find it tricky to get any sort of debt funding. Therefore, it tends to offer a percentage of ownership in return for an equity investment, so that the business can accelerate toward being profitable and generating a return to its investors. It can be difficult to value an early-stage company, as there isn't usually much historic performance to analyze or to base a valuation on. Companies can be considered illiquid and therefore hard to value. VC is considered a long-term investment. This is largely due to the time it takes to grow the company after the initial capital investment. The investment has to be made, the improvements to the company made, whether it's creating a new software platform or expanding distribution, etc., and then hopefully sales and then profit will be successfully driven from this, adding scale and value to the overall company. When a VC fund does make an equity investment through a round of capital, there is an implied valuation of the company. However, it remains illiquid until the company has an exit, for example, an IPO or strategic sale. At that time, the company receives a market valuation, and the VC funds receive a return on their investment. Venture capital is where the investor targets younger companies with high growth potential. Usually, this is by adding experience to scale up a smaller business and drive its profit growth. Venture capital does not take part in leveraged buyouts, which involve large acquisitions of more mature companies significantly financed with debt. VC is equity-only investment. Growth capital, which involves purchasing a minority or non-controlling stake in more mature companies. VCs tend to focus on new companies or turnaround companies. And distressed turnarounds, where the aim is to identify companies which are currently undervalued due to temporary cash flow problems. This is not a typical investment for a VC company. The time horizon for startups varies, but there is a typical evolution of growth by stage or round of capital, and typically each VC fund will focus its investing activity on a specific stage or round of capital. At the pre-seed stage, company development involves concept development, product or service prototype development, and beta testing, and the investor profile includes friends and family, angels, bootstrapping founders, incubators, grants, and other non-dilutive investments. At the seed and seed plus stages, company development sees proof of concept, user testing, product or service validation, and business planning, and the investor profile includes angels, family offices, seed funds, accelerators, and corporate VC. At the Series A and B stages, company development is revenue generation, customer acquisition, company infrastructure development, and the investor profile is angel investors, family offices, and early-stage VC funds. At the Series C and beyond stage, with company development, we see growth, scaling, and profitability, and the investor profile is family offices, later stage VC funds, and venture debt capital lenders. Typically, VC funds do not invest until the Series A round. VC funds are often referred to as institutional capital, and a Series A is often referred to as a startup's first institutional round. Some VC funds will structure their primary Series A fund and carve out a smaller opportunistic or seed extension fund, but these are not the norm. Another recent development has been the formation of seed funds, which is like an institutional VC fund targeting seed stage investments. Let's start by looking at the structure of a venture capital fund. A VC fund is a collective group of limited partners or LPs and a general partner or GP that invest their capital through a VC fund. The invested capital is used to seek out, invest, develop, and ultimately sell or IPO their portfolio companies or portcos to generate a return on initial invested capital. Similar to a PE fund, the VC fund is structured as a limited partnership. General partners or GPs manage the fund and serve as advisors and sometimes board members to the fund's portfolio companies. Investors in the fund are limited partners.
A capitalization table, or more commonly referred to as a cap table, is a spreadsheet that contains the current list of all shareholders, including founders, key employees, investors, and employee stock ownership plans, and their respective ownership of shares or securities, including common stock, preferred stock, options or warrants, and the value assigned to their ownership. There are several purposes of a cap table. Firstly, the founders and employees of a company will want to document and track their ownership percentage and any dilution that comes from capital raising. This will need to be updated each time a new round of capital is raised and also when any other dilutive event occurs. The second reason is that potential new investors who are considering making an investment in the company will want to understand the company's equity ownership profile. The cap table will tell them the percentage ownership that each investor has in the company and also the conversion terms of any convertible preference shares. The implied valuation of the overall company is also included within a cap table. This will all need to be carefully considered by potential new investors before they make any investment decision. Finally, all of the shareholders in the business want to understand what their ownership might be worth at exit. The cap table will detail each shareholder's ownership percentage in the business, how this percentage ownership has been impacted by each new funding round, and also how much each shareholder's percentage ownership could be worth at the time of an exit, if there was to be no further dilution of their equity stake. Dilution refers to the reduction of the percentage ownership stake of each shareholder whenever new shares of the company are issued. Think of the company ownership as one big pie. At the start of the company's life, the founders own 100% of that pie. But each time new shares are issued to new investors, or new employees or new advisors, they each receive a slice of the pie. The founders must share the pie with others, and each time they do, they will see their ownership percentage reduce, or in other words, they will see their ownership diluted. The earlier someone joins or invests in the company, the more they will be diluted as each subsequent dilutive event, such as a funding round, occurs. This means that the founders of a company are impacted the most by dilution and therefore are highly sensitive to changes in their ownership stake and very protective of the number of shares they distribute to others. Every time a dilutive event occurs, the founders and all of the other existing shareholders on the cap table at that time will typically get equally diluted. There are a few exceptions, such as certain securities sometimes having special anti-dilution rights, or if a down round occurs.